mortgage payment actually is made up of a number of different pieces. The most important piece, as we all know, would be the amount of the loan, so the principal amount. Then you also have the interest, which we wish we didn't have to pay. And also we have taxes and insurance. So those make up the typical amount of your loan. Now, some lenders actually do require what's called PMI, private mortgage insurance. And that usually happens if you have less than 20% down on your loan amount. With that, so most of these pieces are included, but sometimes lenders will say, hey, you know what, we're not going to include your taxes. So that won't be in there. But again, it's truly based on the lender, your situation, your loan, and then they decide at that point, and you decide together what's going to work best and how that loan amount's going to look and how you're going to pay that.
The actual rent payment is not impacting your credit score on the mortgage credit report and mortgage credit score. However, a lot of the consumer credit score models do include those companies that don't normally traditionally report to the mortgage credit score. As you all know, there's a consumer credit score model and a mortgage credit score model. So, you know, rent payments typically have not been a part of the mortgage credit score model, whereas they can be a part of some of the consumer credit score models.
Your mortgage, not necessarily will it hurt your credit score. It may have an effect, again, because the whole report is looking at different aspects of what's on your file, how long accounts have been on your file. So again, you know, if you pay it off, it may change ratios, and that may actually, you know, lower your score for a little bit because it's one of the main components that's actually used to look at your credit score. So it may slightly, you know, have an effect, but again, it's not like it's going to hurt you if you had a late or something else that occurred on your file.